Steve Penny from the silverchartist.com joins us today to talk gold, silver, and treasuries. All this and more on this episode of Metal Money. I'm your host, Patrick Vieira. Steve Penny, welcome to Metal Money. How are you doing?
I'm doing great. Thank you so much for inviting me on. First time guest, but I've been listening to you for a while now and really enjoy the content you guys put out. So thank you.
Yeah, thank you for coming by. We appreciate what you do as well. We follow you on Twitter and put out some pretty amazing work, pretty amazing charts there. So we appreciate your work as well. Steve, can we start with asking you if you can share with us what you see on your charts for gold? Is the correction in gold over, and are we starting to turn that corner?
That's the big question, and we haven't confirmed a bottom yet. I'm optimistic. I think there's a very strong support zone between 1690 and 1715. That level is reinforced by the lower boundary of this 8-month downtrend channel. And that also coincides with the 0.618 Fibonacci retracement level. So you've kind of got a confluence of support right there, right around $1,700. And I think the most likely scenario is that holds. I like to say I deal in probabilities, not predictions. But I think the probability is that holds. But that doesn't necessarily mean that we're just going to turn around and, have a V bottom and go straight back to new all-time highs in such a short period of time.
Can you tell us more about the 10-year cup and handle pattern on the monthly candles chart for gold? When do you expect the handle to fully materialize or fully form? And what do you think the price point for gold will be then?
Absolutely. So if you look at like a 10 or 12-year chart for gold, you'll see this big rounded cup. They call this a cup and handle pattern. And so you've got this rounded cup, and then the handle typically retraces maybe about a third of the recent run up. So we've done that. Now, if you take this last 7-month downtrend channel, which began in August of 2020, typically these handle patterns are kind of symmetrical on the way down and on the way back up. So if it took 7 months to come down, it's reasonable to expect it to be about 7 months on the way back up. But first, we have to, of course, carve out a bottom first. So that would put us back near the all-time highs of $2,089 towards the end of 2021. Now, of course, like silver and gold and precious metals markets are always capable of a very sharp rebound at any moment. I feel like they're a beach ball that's kind of like held underwater and could pop up at any moment. But just assuming like basic technical analysis would suggest $2,089 will be tested towards the end of the year. And that's my baseline scenario.
How about silver? At what level should silver consistently close at before we could conclude that we're off to the races with silver?
So the $29.92 was the high in August of 2020. And then about 4 or 5 weeks ago on the silver squeeze movement, I guess it was about 8 weeks ago now, we popped up to $30.35. So let's just call it $30, right in that little zone, right around $30. Once we get a weekly and then monthly close above 30, I think silver can really run pretty fast. And, I think once we get above 30, we'll probably be headed towards those all-time highs in fairly short order, up near $48.
Between silver and gold, which do you see as having run into more resistance?
Well, let's see. So to address that question, you always have to ask what time frame we're talking about, in the short term, intermediate term, or long term. And gold, strangely, has pulled back more than silver. And, typically you see silver, the more speculative aspects of the precious metals complex, pull back more in these corrective phases. But this time it's been weird. It's like the senior gold miners have pulled back more than the silver miners, and gold has pulled back more than gold. Or excuse me, gold has pulled back more than silver. So that gold to silver ratio got as high as 123-1 back in March of 2020. And that was like an all-time record. We had never seen that before. I don't think that's ever happened, like going back probably hundreds of years. And since then, silver's outperformed gold by almost a factor of 2. Now, we do expect silver to outperform gold over the intermediate to longer term. However, that ratio is compressed so far, so fast, that I think a likely scenario here would be gold maybe outperforms in the shorter term. And of course, that can happen one of 3 ways. Silver can kind of hold its ground and gold catches up. Both can rise, and gold just rises faster in the short term. Or, hopefully we don't see this, but they could both fall and silver just falls a little bit faster in the short term.
You expect the silver to gold ratio to snap higher after the recent sharp decline. And which is more likely? Are we going to see gold prices perhaps appreciate more than the rise in silver, or gold prices start to rise and we see silver prices falling?
Yeah, well, it's hard to know. I think it may be a likely scenario is they kind of meet in the middle somewhere. But like I said, over the intermediate term, I mean, we're so much more bullish on silver than gold. Just in the short term here, I think gold presents perhaps a more compelling risk reward scenario for taking long term positions right now.
Can I ask what makes you see silver as more bullish than gold right now?
Just for one, that gold to silver ratio is still at like 67-1 last I checked. And typically in bull markets, that ratio peaks around 15-1. Doesn't typically stay there very long, but I fully expect that to happen again, if not lower. Silver is pulled out of the ground at a ratio of like 8-1 relative to gold, and it's consumed in industry. So I think 15-1 gold silver ratio is a totally reasonable target near the end of this bull market.
Can you share with us your analysis of the 40-year weekly chart for the 10-year Treasury yield and how it sort of gives us clues as to the road ahead for precious metals?
Absolutely. Yeah. We put out a report every Sunday, and one of our contributors, Kevin Wadsworth, put out this really nice chart detailing nominal yields versus real yields on the 10-year going back like 40 years. And really the significance of that chart from my perspective is that initially when nominal yields rise, the kind of knee-jerk reaction is to sell metals. And that's, unfortunately, a lot of our markets are driven by these high-frequency algorithms and trading algorithms. So the knee-jerk reaction is to sell the metals. But what really matters over the long term is the real rate, the real yield. And the way to get that simply is just take the 10-year yield and minus the CPI, or I call it the CP lie because it's government data, which we know is not a reflection of reality, but nonetheless, that's how we get real rates. And when rates are negative, I mean, that's about the most bullish factor for the metals over the long term. And just in the last few weeks here, I think this is an anomaly, but real rates have gone positive, and that's really led to part of the sell-off here. I don't think that's going to last, but that's the scenario we're in right now.
Yeah, CPI, got to remember that one. I mean, especially when they choose to leave out food and energy, which are things that we all consume and need every day. Steve, which is more likely in the coming months ahead? The Fed to continue money printing and keeping rates down, or might we see the Fed hike rates to combat inflation? Because as we know, inflation, it's going to start to pop assets.
Yeah, I think it's highly unlikely that they're going to let rates rise to the point where they prick the everything bubble, as I call it. Because literally, like everything except for commodities are in a bubble right now. And so the Fed and central planners really around the world, but especially here in the United States, have one of two choices. They can either default honestly, or they can inflate away their debts, because it's mathematically impossible to make good on these unfunded contingent liabilities that they have and these debts. It's just mathematically impossible. So history suggests that 100% of the time, without fail, they choose to inflate away the debt because people don't understand it. They turn and blame each other. They blame the corporations. They blame everyone except for where the blame actually belongs when they inflate the debt away. If they let these bubbles burst, the blame's going to turn squarely on them. And I don't think they want that.
Why do precious metals seem to do worse when the 10-year Treasury yield goes up?
Yeah, like I said, it's the knee-jerk reaction of these institutional trading algorithms. Rates go up, sell gold. Eventually, that is going to break. I mean, history suggests, going back to even this late '70s bull market, towards the end of the precious metals bull market, nominal rates tend to rise along with the metals price, and the reason is because real inflation is higher than the yield on those 10 and even 30-year treasuries.
Steve Penny from thesilverchartist.com. We thank you for your time, and I hope we can do this again soon.
You bet. Thank you so much for inviting me. Great to speak with you.
There you go, Steve Penny from thesilverchartist.com. Puts you in the know where precious metals just might go. As always, let us know your thoughts in the comment section below, and remember to keep it liquid, keep it real, and I'll see you on the next episode of Metal Money.